What's going on, everybody? Michael Silva. Today we got a very good episode. We're going to be talking about how to navigate the stock market's biggest competitor. So we're going to get into what that competition may be and then how exactly we're going to go about navigating that. So let's just go ahead and get into the show. All right, welcome back. Now, before we go through all the charts and so forth, we got to talk about what is the biggest competitor and what are we competing against? Well, we're competing against the average stock return. And right now I'm just using an example. The last 30 years, it's roughly 9.89%. I've seen 7%, I've seen 8%. So we'll just say 9% typically around the average. And we know that it's been more volatile these last few years. Now, when I go over here and look at treasury yields, this is February 15th. We're getting a lot of these yields creeping up into around 5%. I know we've been talking about the yield curve inversion. We'll be showing that later. But as the yields start to increase and also the Fed's funds rate continues to rise, people are going to start looking to save more money because savings account rates are obviously going up. And then people look to less risk, might take money out of the markets to go into something like T-bills or short-term treasury securities. So that right there could be a very big competition. Now, I know that it's far off from, 9.89%, but if you could be risk-free getting 5%, potentially 6%, that is a big, big deal and could be a very big competition there for the overall markets. Now, if you take a look at year-to-date performance overall and the 11 sectors that make up the S&P 500, the markets are doing quite well, right? Consumer discretionary, pretty risk on, up 20%. XLC, there's communications, up almost 20%. And then the tech sector is up nearly 16%. So how do we navigate this, right? Because the tape is telling us something, but then also we're getting some macro headwinds. Well, let's look at Martys Zwag's, I can't pronounce his last name, investing rules. And the very first one here is don't fight the tape. What does that mean? So this is going to help us navigate the big competition here. So don't fight the tape. The tape is telling us that the market is currently bullish, right? Price action is going up. Volume has been moving up. The market is on a monster tear. Now, if you go down further down this list, number 6, it says also don't fight the Fed. Now, the Fed is in a tightening cycle, and they're telling us, and they've been acting very hawkish, meaning that the markets, are acting pretty loose right now for what the Fed is actually doing while raising rates and quantitative tightening. So they kind of are, fighting back and forth right now. But as it stands right now, it says less valid than number 1. So currently we got to focus on the tape. And that's why we've been very focused on the charts overall and the price action and so forth. But we're well aware of what is taking place with the Federal Reserve. Now, macro reports that have been coming out this week alone, we had inflation data, we had retail sales today, and then tomorrow we have PPI and also building permits as far as some of them. So let's just kind of go through that data really quick. United States inflation rate, the consensus was 6.2. It came in hotter than expected at 6.4%, but it still decelerated from the prior report. It also decelerated on the core inflation rate from the prior report here too as well, but it did go above consensus at 5.6%. As far as it stands right now, U.S. retail sales that came out, it came in pretty darn hot at 3%. I did find this chart interesting, even though that they increased, right? They increased 3.9% over the last year, but that's also the lowest growth rate since May 2020 and below the historical average. And then once you adjust it for inflation, the picture gets a little bit worse, where they declined 2.3% over the last year, the fifth consecutive year-over-year decline. Now, this is very interesting because as retail sales go up, so is credit cards, right? Credit card debt is now hitting a record at $930 billion. And that's on the back of also a, very, very high credit card interest rate that continues to just rip higher and higher. Also to note, on the back of a personal savings rate that's as low as we've seen since really around the start of the great financial crisis. Now, as we stated, we have the building permits coming out tomorrow and PPI. With all this data that already came out, what has the market done? The market actually hasn't really responded at all. It hasn't moved. And what do I mean by that? Well, this right here is the upper weekly expected move. This is the lower weekly expected move. And this right here is just the start of the week. Now, we are above the February anchored volume weighted average price, and we're also above the week-to-date volume weighted average price here too as well. And if you see this box right here, this is just the price action for this week. And as you can see, the price action has just been choppy and sloppy. And overall, we're just in, basically just this chop box. Now, understand we have a couple of trading days left, and there's a lot of volatility packed within this week where we can come up to around 418.48 and 397.60. If we came all the way down to this lower level, we shouldn't be shocked because 68% of the time, price action closes within these weekly expected moves. As it stands right now, we are trading above a flat to inclining 5-day moving average, which is positive. If we start breaking down from there, be a little bit more careful. Now, remember, it says number one rule is don't fight the tape. So when we take a look at the tape, we'll look at the SPY on the daily time frame. I'm going to go ahead and anchor a VWAP right to the year-to-date starting point. This tells us what the volume-weighted average price is year-to-date. So price action is currently above it, which means that the average buyer, based off of this time and volume, is in the green. So I would say, as it stands right now, price action could currently just be flagging, consolidating, chopping in this box, and it is still above a year-to-date anchored VWAP, which makes it bullish. Now, I would be watching this area right here to potentially become a little bit more bearish. If it starts breaking down from there, that opens the door to the year-to-date anchored VWAP and potentially the lower trend here. But as it stands right now, if this flag wants to continue to break out, there is a possibility that we start ripping higher to around the 430 marker. Now, that doesn't mean it's going to happen overnight, but that is a possibility. And when you really zoom out here and just take a look at some of the other rallies that occurred, now, these have been huge rallies, but remember, price action hasn't actually gone anywhere since this. Actually, which I find interesting is we're starting to see consolidation, a bullish consolidation, very similar to how we saw it right over here. So, we got to just be cautious and careful because this right here was pretty bullish looking, and these moves caught obviously a lot of people off guard. Now, this rally over here was 16.35%. This one was 17%. And this just up to here would be 15%. So this rally so far, it hasn't been all too outstanding. And the rally really started when it kicked off, when it broke out through here, back tested and started moving higher. I wouldn't consider this rally starting from here because of this breakdown. So yeah, if it starts moving up, even back up to 430, it's a very similar type rally as we've seen in the past that did get faded. Now, if I look at a week-to-date perspective, take a look here. We've been seeing a lot of chop. Well, understand that this candle, 2 weeks ago, this was a pretty large range candle. Last week was just an inside trading candle. So all we did was trade within the week. Okay, and now what are we doing? Well, we're trading within that week. So right now, price action is just tightening up. It is just coiling up. So it's going to need more time here, and this could be a consolidation, right? Consolidation to potentially break higher, and that's always a possibility. That could take us, like I said, to that 4,300 potentially up into this range and go test this prior swing high. And try to overcome that area of supply. So just remember, right? All we're seeing right now is just an inside trading week as it stands. The PMO is up, so I'd be careful if this starts flattening out in the coming weeks. We did reclaim that 50 downsloping weekly moving average. Now, if I take a look at Bookmap for ES, it did map out a couple key levels going into tomorrow, right? So this is the close of business today. And then we had the opening right over here on futures. And then what I want to just call out here is 4,200 has a little bit of a spike, 4,195. And then this level came in, and this level came in after the close of business. So 41.95 and then 4115. So those levels could be interesting to watch going into tomorrow's trading session. If it goes down further than that, I'd say 40.75. That one's been there for a little while, just like 4,200's been there for a while. So as we are looking into tomorrow's price action, pay attention to obviously those levels. We did mention the yield curves, right? The yield curve is still deeply inverted. So this comes back to, right, we don't want to fight the tape. Right, we're talking about the tape. Now we're going to talk a little bit more about okay, don't fight the Fed. Well, we also have a very deepening yield curve. It was even deeper today, intraday, but it changed slightly. If you look at these yields up here, so like the 3-month is at 4.79, and take a look at like the 6-month. The 6-month crest into around 5%, which is levels that we haven't actually seen really since 2008, 2007. Now, if we take a look here at the probabilities of rate hikes for the Fed, this is getting pretty interesting to me because take a look at this sudden change, and the market really hasn't responded poorly to this. If you take a look at the March, we're looking at another 25 basis point hike. There's an 86% probability of taking us to 475 to 500 basis points. And then if we go to the May, it goes up again, which is interesting, to 500 to 525. Okay, so we've kind of known something around these levels is going to take place, and they've been talking about that. But what I find interesting here is in June, this is actually going a little bit higher than what the Fed has been talking about. This is 525 to 550 and holding it for pretty much the remainder of the year instead of December. So this, to me, when you take a look at retail sales and you take a look at inflation and you take a look at what's been going on overall, the Fed doesn't really have a reason to slow the pace of rate hikes or to start cutting. The reason why they would cut would be potentially because something eventually breaks and we go into recession. So as it stands now, I mean, the Fed is hawkish. The Fed is going to continue raising rates and hold them, and the market is pricing this in as it stands right now, where we can have, a Fed fund rate at 525 basis points to 550 basis points with a pretty strong probability there. And if they continue the tightening cycle here too as well, understand that when they start tightening like this, it does add a lot more liquidity into the markets, which causes a lot more volatility. Okay, so back to over here, Marty's sayings over here. Number one was, let me fix that. Number one was, don't fight the tape. So the tape is bullish right now, okay? So you don't want to chase the tape way up to here. You want to see if it consolidates and pull back and sets things up. So like in my Patreon, I've been setting up a lot of different long setups because the current market is just pressing higher, okay? And if you're going to fight it, you just got to be very aggressive with taking those shots, fading these type of intraday moves. And also, if you integrate these zero date expiration options, it's just adding some monster gamma squeezes both to the upside and downside in the markets. But then overall, the next most important subject over here is don't fight the Fed. So if we put these two together, and you look at the overall markets, we can just map out key levels and say, okay, well, as long as we're above this year-to-date anchored VWAP, I can be bullish. We'll look for positive setups. But if we start getting below this, that could be a pretty nasty setup overall. Now, if I take a look at some of these stock market indicators, the summation index now is day 3 of crossing over the parabolic SAR. So we'll see here if it's going to turn back up or if it's giving us an early notice and this is just moving up higher and it's going to catch up eventually to the downside. That's a possibility. We can see here that the breadth has been not all too great. And if you look at the daily charts, the volume was kind of lackluster today too as well. Take a look at the summation index for the New York Stock Exchange, day 3 or 4 actually of the parabolic SAR ticking like this too as well. The market's been kind of flattening out. So is this going to pick up some pace to the downside and start seeing the market sell off? It's a possibility. I would definitely, like I said, be aggressive with profit taking in this environment, be a little bit more cautious of overextended markets and breakouts and so forth. Another big one to watch is obviously the dollar, right? How we navigate this. The dollar actually had a pretty strong move. So we're talking about it, the biggest competitors, right? Could be the bond market, could be people flooding into more risk-free type, assets like savings or T-bills or short-term treasury securities. But take a look at the dollar. If the dollar starts spiking, that could be a flight to safety. And we already know that when the dollar breaks down, that actually typically helps the S&P 500. And as it stands right now, the dollar had a pretty strong move today and the market didn't actually respond. So one of these is line, because if we get a strong move with the dollar, especially at a rapid rate of change, that could put pressure back on the S&P 500. Also to note, the 10-year yield, right? It had that bullish crossover, that positive divergence, and is starting to move up. So this is going to potentially put pressure on growthy type names. And we've been actually seeing growth actually perform quite well overall, including this year. So if the rate of this continues to rise here, I would imagine from a relative standpoint, that's going to put pressure on consumer discretionary and also technology stocks. Also to note is copper, right? So is this like China reopening, thing? Is it starting to fade a little bit right now? It was down 1.58% today. And as you can see, we talked about like, sometimes, there's like a sudden positive divergence and then we got that pop up. Well, that was a small one, but we also had the larger negative divergence here. And now what we're seeing is a big move down, but then today was a big move up. So is this sideways consolidation bearish and potentially going to head lower, which could put pressure also on the S&P 500, which we've seen in the past. If we take a look at gold, when you have the dollar up and you have yields up, that puts pressure on gold. This could be a buying opportunity here in the near future. I talked about it on this specific day, and I I showed the chart. I said, I would like to see it lower into around this area. We started to see it flag a little bit, right? And then it started breaking down from that flag into right around in this area. So I'll be looking into here to potentially start looking for some gold trades, whether it's just gold itself or potentially I might look into miners. I might look back into silver and silver miners too. That's all I got for you on today's episode, everybody. Hope it helped out and give you some insight into the overall market. See you later.